Okay, welcome everybody to today's webinar, SMSF Benefit Payments, Tips and Traps. I'm Tim Miller from Smarter SMSF. So listen, today I've put together this webinar, which is pretty sizable from a content point of view. So you will all attendees will get a copy of the presentation after the event, along with the CPD. So I'll be going through at a fairly rapid pace, but as with always, if you've got any questions, please be sure to put them in the Q&A box, and I'll get to them as we go through the session. Standard disclaimer applies. Look, there's a lot of stuff happening in the super industry at the moment from a change point of view. Nothing necessarily significant in the benefit payment space, except what I would say is that the regulator is making a number of updates, some of which I'll run through today's session. And as of yesterday, even, they provided a whole heap of information on their website, the ATO website, in regards to release of super in relation to compassionate grounds. So certainly for anybody that's looking at accessing superannuation proceeds under the guise of compassionate grounds, there's some really useful information being provided in quite detailed there from the ATO. So I'd encourage people to go and look that up. And if I remember, I will I'll put a link to it in the CPD email as well, because as I said, it's quite valuable, but probably a bit too much information for me to go through in today's session. So we will be looking at the different types of benefit payments, how the nature of those payments can impact the timing and the treatment of them, and then the taxation implications of accessing super both legally and illegally. And I'll finish off today with a bit of a case, which hopefully won't necessarily impact us all, or hopefully, when I say it won't impact us all, hopefully we don't ever have to come across a scenario like this one. But it certainly highlights the issues associated with illegal access of superannuation and what it can actually cost you from a trustee point of view. And specifically in this particular case, the trustee was an SMSF professional, and I use those words loosely based on the amount of money they accessed, and then sort of the crying poor that they did with regards to the regulator and the Administrative Appeals Tribunal. So anyhow, let's jump into this session in light of how much information that I want to get through. So from an accessing superannuation point of view, you'll see there, I've identified all of the key elements of accessing super from a condition of release point. And this is our key area from the SIS regulations. So SIS dictates to us how we can access our money, and when any cashing restrictions that might actually apply to it. So whilst I haven't necessarily included all of the conditions on there, these are all of the conditions as they impact largely self-managed superannuation funds. Now, when we take those conditions to a further level, we look at the cashing restrictions that apply to them. So if we're accessing superannuation under temporary incapacity, compassionate grounds, under a release authority, first home super saver, but also under retaining preservation age, then there is a cashing restriction in place. Now, we know that from a TRIS point of view, that cashing restriction is that we have to follow the minimum pension requirements, but our maximum is going to be fixed at 10%. So that's something that we have to factor in. As far as no restriction on how we access our money, then we've got our grand old retirement, terminal medical condition and permanent incapacity, and of course the only compulsory cashing requirement, which is death. And then we've got turning 65, which is clearly the go-to strategy for most people. And we've spoken recently about contribution strategies and the like, and of course 65 is that sweet spot now where we can access our money, but then we can start looking at that simple churn through with recontributions or whatever else we decide for then the following 10 years. So 65 is clearly the sweet spot as far as superannuation there is concerned. So that's sort of the key areas as far as accessing super is concerned for us, and all the areas that we need to look at with regards to what we can and when we can't take in absolutes money out of the fund. And then we've got one other condition, and that other condition is financial hardship. Now, financial hardship is largely a condition of release that has a cashing restriction, and that cashing restriction is between sort of $1,000 to $10,000 from a financial hardship point of view. But the cashing restriction is removed if you are accessing under financial hardship and you have reached your preservation age. So then once we move from the cashing restrictions, we look at how benefits can be paid. And we've got the capacity under super law under the SIS regulations, again, to pay our benefits either as a lump sum, an income stream, or a combination of both. And so when we look at the various conditions of release, we know that from a release authority and from financial hardship and compassionate ground point of view, they are all restricted to receiving benefits as a lump sum. When we look at income streams, then temporary incapacity and attaining preservation age must be taken down as an income stream, and two quite distinct income streams between temporary incapacity versus a transition to retirement income stream from an account-based pension style arrangement once you attain preservation age. And then you've got retirement, or then you've got sort of the I guess the conditions that give you the capacity to choose between a lump sum or a pension. Now, comments just been raised there. Retirement isn't an absolute. No, that's correct. It's not an absolute with regards to the preservation of super, which I'll talk about in a moment. But it is an absolute with regards to if you satisfy the definition of retirement, then you can unrestrict your benefits that are in existence at that point in time that you meet that condition of the retired. Sorry, let me say that again. When you retire, right, at the point that you declare that you have retired, you will unrestrict your benefits. If that retirement occurs prior to age 65, then obviously any additional benefits that accrue in the fund or any more contributions that you make will be preserved until you satisfy a further condition of release. So retirement without moving your money into an income stream still results in you having preserved benefits inside the superannuation fund. So yeah, we've got the capacity to pay either a lump sum or a pension when we hit retirement, turn 65, medical condition, permanent incapacity, and death. So from a preservation point of view, we've then got our preserved benefits, which all of the money that enters the superannuation system since 1 July 1999 are preserved until we satisfy a condition of release with nil cashing restriction. Obviously, there's still a few funds around out there that would have restricted non-preserved benefits. It's not something you see a lot of in the SMSF space unless there's a rollover that is received. And then we have our unrestricted non-preserved benefits, which are benefits where we have satisfied that condition of release with the nil cashing restriction. And they ultimately mean that we can access our money however we choose. We then look at our priority of cashing upon withdrawal. And so what we need to understand here is that where we have a nil cashing restriction, everything goes to be unrestricted, non-preserved, and there's no issue there. But if we satisfy a condition that does have a cashing restriction, and probably the most obvious one is transition to retirement income stream, then we have to draw our benefits down in the legislated order. And the legislated order is that it comes from our unrestricted non-preserved benefits first, then from our restricted non-preserved benefits, and then from our preserved benefits. So, if you start a TRIS and you do have unrestricted non-preserved, then that is diminished relatively quickly. And any growth that the fund receives will actually go in as preserved benefits. So, you're ultimately, if you go down that single pension strategy from a TRIS point of view, then you're obviously going to dilute your unrestricted benefits pretty quickly versus having, say, a two pension strategy where you start portion with unrestricted and a portion with preserved benefits. So that's how we access it. And of course, preservation age, which is the trigger of many issues, is when we can access that transition to retirement income stream, and it's also the trigger for determining things like the low rate tax amount with regards to lump sum benefits. And the key for this is that we are now in that period, which I call that sort of awkward age period, where we talk about preservation age being 59, but it's no longer 59 in the sense that anyone that was born anyone that's turned 59 since the 1st of July this year, right? So if they were born on or after to 1 July 1964, then they have to wait to age 60. So anyone born on the 30th of June this year can be not born on the 30th of June this year. Anyone that turned 59 this year can already access their superannuation in the form of a tris, but those that were born on or after 1 July have to wait until next year and turning 60. And of course, how we then access that will then have quite a huge impact on the taxation, which I'll move into in a moment. So when we look then at the payment types from our superannuation fund, and again, when we're talking about benefit payments, we're inclusive of all types of ways that money can come out of the system. Well, the first way that we have is that we can access our benefits as a lump sum, and again, put there that it's subject to the trust deed because the legislation provides for it. Now, it's interesting. I was listening to another speaker recently, and they highlighted this long-standing piece of commentary, which is that if you have individual trustees, that the deed and the legislation, in fact, requires that the primary purpose of the fund must be the payment of the pension, and that's absolutely correct. But it doesn't restrict you from paying lump sums. So as long as the governing rules provide for the ability to pay a lump sum, so you've still got to have that overriding purpose to pay a pension, but one-off lump sum payments or indeed commutations from the pension are certainly not problematic in that existence. So we can pay lump sum benefits from super, and as I alluded to before, certainly there are times when we must pay a lump sum, and then there are times when we have the choice to take the lump sum or the income stream. Now, one of the key sort of considerations with regards to lump sums is this concept of the in specie payment. So, we talk about in specie, and I particularly talk about in specie a lot when dealing with contributions from a timing point of view, where we want to transfer an asset, so an acquirable asset under Section 66. If we want to transfer that into the superannuation fund, then we will do that via an off-market transfer, so an in specie transfer, and then that has valuation consequences. And those valuation consequences are linked to the timing of the transfer. So when do we execute the off-market transfer? When do we execute the land's title transfer? All of those issues are relevant when it comes to in specie contributions, and similarly, they're relevant when it comes to in specie benefit payments. So as far as the payment of a lump sum benefit is concerned, if we make that election to pay a benefit via an in specie transfer, then when we execute that transfer, so when both parties execute the transfer from the seller and the buyer point of view, the day that is executed, so the day that we put on the transfer form or the titles document, is when it's going to correspond with when that payment is actually made. So again, if there's a delay with regards to a benefit payment from a timing point of view from the signing position, then that's going to mean there's a delay in regards to when it is counted as being paid. Now, one thing is very clear when it comes to in specie benefits, and that is that pension payments must be made in cash. And this has been a long-standing position of both APRA and the ATO with regards to pensions, is that pension payments must be in cash. So if we are contemplating doing an in specie transfer of assets from a pension interest, then we would need to do that in the form of a partial commutation. And I'm going to touch on commutations as we go through the presentation today. So again, I've got the example there of Claire, who's retired and wishes to take a lump sum of 50,000, doesn't have sufficient cash, so instead decides to transfer 2,000 shares in ABC with a current market value of $25 per share, which is 50,000, and she does that as an in specie lump sum. So of course, the key consideration, or one of the key issues to deal with or to do with in specie transfers comes a lot to do with your own balance and whether or not assets are particularly segregated to the member, or in fact, pooled across the entirety of the fund. And I came across a scenario just last week in a presentation that I was doing where we had a situation where it was a fund with a parent and siblings, and the parent had commenced a pension, and they commenced that pension with let's say balance A, and had the sons in the super fund as well. And then after that point in time, they chose to segregate. Well, sorry, there was a pension within the fund, so not a pension, a property within the fund, and they segregated that pension or segregated that property. I'm doing very well with my words so far today. They segregated that property into the pension. Now, what they hadn't done was they hadn't revalued the property at the commencement of the pension. So the cost base that they included, or the valuation that included the pension, did fit within the member's balance. But if they had have correctly valued it prior to the commencement, then it would have actually sort of impacted all three member balances. And ultimately what it resulted in was the father having more money than the sons, and the sons ultimately arguing that he had wronged them and wronged their balances by doing this valuation later and segregating this property over to them. And so really the point of what I'm trying to say there is that when we're looking at doing things like in specie benefit payments, we need to ensure that the value of the asset isn't greater than the value of the interest that we're trying to pay the benefit out of. So just some things to be mindful of. And then of course we've got the income stream requirements, so we can pay our benefits, as I said, as a lump sum or as an income stream. And one of the key things about the income stream, and this is pretty critical, and I'll touch on a little bit as I said, the ATO releases in a moment. But when we start an income stream, we have to make sure that we satisfy the definition of an income stream, and that definition is a series of periodical payments that are made to a member. And we've got this tax ruling 2013-5, and that's just been re-released in draft format, and the comments for that closed last week, or last weekend. And that talks about this definition of what is a series, and a series is obviously more than one. So whilst we pay a pension, we can pay a pension annually. For it to actually be considered a pension, we've got to pay it for more than 1 year. So the ability to start a pension, to draw one annual payment, and then to stop that pension would suggest that we only have paid a lump sum. So based on the ATO's ruling, and this goes all the way back to 2013, you've got to have at least 2 years of single payments for it to be considered a series. The other thing, of course, about income streams is that we create a separate interest each time for self-managed super fund purposes. So what that does is it distinguishes, say, tax-free and taxable proportions at commencement, as per the proportioning rule on the slide there. And then it gives us the understanding from a taxation position how that benefit is going to be split when we pay out an eventual benefit, either pension payments or indeed a death benefit upon the death of the member, paying it out to either dependents or non-dependents. And that can all be relevant, and it's relevant in regards to the taxation. And so when we talk about the taxation, we have to understand how tax works with regards to both lump sums, but also with regards to income stream payments. So the payment of a lump sum is going to be taxed based on the tax-free component, the taxable component, which includes our taxed element, and the taxable component being our untaxed element. Now, the untaxed element is rare, to say the least, in the SMSF space, but it's not non-existent. So it can exist if we are paying particularly a death benefit to a non-tax dependent where there are insurance proceeds involved. So if a member passes away prior to age 65 and they had insurance and the benefits are paid out to, say, an adult child, then there will be a calculation of an untaxed element. So these are things that need to be factored in, and we need to understand that there is additional tax that will apply in those circumstances. So when we look at the various tax rates, we know that 60 is our key age. And if I go back to that preservation table, the fact that we're now in, well, what have we got? So 7 months or 7.5 months now of timing until everybody's preservation age moving forward is 60. And so that ties us into a really nice position where everybody that can access super legally, other than sort of early under compassionate grounds or financial hardship or something. So everyone that's accessing it under your standard retirement condition will be doing so from age 60. So all income is going to be non-assessable, non-exempt income. So we're not going to have any tax to pay on that taxable component. If we've got an untaxed money, then we do pay tax on up to the first $1.7 million. Now, again, very rarely do we see that occurring in the SMSF environment. If we are between preservation age to 59 or more to the point to our 60th birthday, then we don't pay any tax on the amount up to the low rate cap, 235,000, and then above that, we pay tax at 15%. So again, because preservation is now at 59, this really is limiting in its sort of execution and tax collection methods, because for most of us that have been around long enough, we used to talk about preservation as being 55, and so the low rate cap had some meaning. But in 7 months' time, the low rate cap is ultimately going to be inconsequential from a superannuation point of view, because preservation will be 60, and therefore everything will be non-assessable, non-exempt. However, if we access our super prior to preservation age, then the applicable tax rate is 20% plus the Medicare levy. So if we are accessing money under financial hardship, under compassionate grounds, then we do have to recognise that there is going to be a tax impost on that amount, and so we're not actually going to be in receipt of what we think we might actually be in receipt of. Now, of course, the concept with financial hardship is maybe the income is low enough that the payment won't actually require tax to be paid, but the fund must still withhold it, and then you would need to go through the lodging of the tax return to get that tax back. So again, the low rate cap, just to reiterate what that is it determines at what point in time tax needs to be paid on that lump sum. It is indexed in accordance with the average weekly ordinary times earnings, but it becomes somewhat irrelevant from the 1st of July 2024. As far as tax on income streams is concerned, and I won't really focus too much on the untaxed type of funds and the payment of those pensions, although they do apply if we've still got defined benefit income streams and we're above that $1.6 million at that point in time. But again, if we're over 60, then all of the income is going to be non-assessable, non-exempt income. And if we are from preservation age to 60, then we pay our marginal tax with a 15% tax offset. So I just got another question that came through. Did I hear correctly when you said that pension payments can be made or can't be made with an in-specie transfer of assets? That's correct. So you cannot make a pension payment with an in-specie payment. It must be cash. Now, for those that are turning 60 during the year, the strategic approach to this sort of issue is, okay, well, do we just take that pension after our 60th birthday and then have that amount treated as non-assessable, non-exempt income? So that's the issue for anyone who was born before the 30th of June 1964, who commenced a TRIS this year, that they would need to look at saying, okay, well, if I'm not going to turn 60 till late in the year, but I need income, then I'm going to have to withhold tax. If I can hold off till after my 60th birthday, then it'll be non-assessable, non-exempt income. But again, the margin for that sort of conversation is getting smaller and smaller by the day. So that's all of that stuff there is ultimately, I guess, what I would contemplate or what I would consider as our stock standard SMSF technical knowledge that all of us have with regards to how the rules operate around tax and payment types, and when we can make a payment and how we can make a payment and under what various conditions of release. What I want to focus on now for the remainder of the webinar is really to dig into a number of the issues that occur around benefit payments. And when I say issues, they're not all like bad issues. They're the issues as to, what are our considerations? Should we take, say, in regards to a pension, should we take our benefit as a lump sum or should we take it as a pension? Do the rules provide for it? So those sorts of considerations before then I finish with the issues associated with illegally accessing your superannuation proceeds. So yeah, when we talk about our pension issues, the first thing that we really need to talk about is what are the rules around what happens upon the commutation of a pension. And we need to understand that there's a significant difference between a partial and a full commutation as well. So the ATO have provided us some commentary, and as I mentioned, and as I've got a link within the presentation as well, TR 2013/5 is effectively our, not just SMSF because it's a tax ruling, but it's our go-to guide with regards to when a pension commences and when a pension ceases. So the definition that I gave before of an income stream and representing a series of payment, that is found in TR 2013/5. The various triggers to when a pension stops, i.e. failing to pay the minimum, upon fully exhausting the benefits, upon death if there's no reversionary, all of that information is sourced from TR 2013/5. So it is our go-to guide with regards to particularly how the ATO regulate pensions in accordance with SIS and the Tax Act. And so what we have to understand is that the primary difference, and I'm going to come back and talk about partial commutations, but the primary difference between a partial and a full commutation is that a full commutation ceases the pension. And based on the wording within the ruling, the commutation happens first. So if you are saying you want to do an in specie, and this sort of comes back to the in specie versus cash payment before, if you want to do a commutation and if you want to stop your pension, but you want to do an in specie transfer of some of the investments that are held within the pension and you want to transfer them to yourselves, then what you've got to contemplate is, do I wish to do a partial commutation first and transfer that asset whilst it's in pension phase, or do I want to fully commute the pension and then transfer it? So the ATO have highlighted within that ruling that the commutation comes first. So if you're doing a full commutation, the pension stops and then the lump sum occurs. And so by the lump sum occurring at that point in time, it's going to then have an impact on both capital gains tax and ECPI. So it's one of those key issues, particularly if it's that the fund is going to continue on and it's moving out of pension phase to accumulation phase, then that sell down is going to have an impact on the tax position of the fund. Versus if we're taking a partial commutation, so if we're choosing to pay a benefit out of the pension interest and that benefit we want to take as an in specie lump sum payment, then to do it as a partial commutation for just that asset will not have any CGT implications. It won't have any ECPI implications. So it's just recognizing that timing is pretty critical when it comes to the full commutation of a pension. So the other thing we have to be mindful of with a full commutation is that we've got our pro rata minimum pension requirement. So again, when we differentiate between a partial commutation, which just requires us to ensure that either the minimum has been paid or we've got sufficient liquidity for the rest of the year to pay the minimum as calculated at commencement or the 1st of July. With a full commutation, we need to ensure that the pro rata pension amount is paid prior to the date that the commutation takes effect. And so that becomes one of those sort of administrative anomalies that I've often spoken about in this space, and that is that you're always better off commuting a pension on the 30th of June versus the 1st of July, because if you commute the pension on the 1st of July, the tax office don't give consideration to the day or the time of day that you make a commutation. And so by doing it on the 1st of July, there's enough evidence, including going back to the National Tax Liaison Group, which was the way that the industry used to communicate with the ATO. There's evidence to suggest you have to do 1 day's pension payment. So that's why 1 July is not necessarily a great day from a commutation point of view. So that pro rata minimum pension requirement is fairly important. And as I sort of alluded to before, the ECPI is relatively critical as well. So, if you've got segregated assets and all of those assets are segregated in pension environment, and then you commute and go back to accumulation, then you're basically going to be at full tote odds CGT with regards to there's no longer any exempt current pension income. Whereas if you're proportioning and you've still got some money left in pension and some in accumulation, then that actuarial certificate can actually make quite a difference from an ECI point of view. And that might be a subject for a webinar into 2024, the whole concept of the segregated periods and disregarded small fund assets and the like, because it's clearly a subject in itself versus a couple of lines within a presentation. So that's what we need to contemplate when we're dealing with primarily with full commutations, is what that means from a timing point of view. So I've just had another question come through. So if an SMSF has a pension account and has a loss during the year, could the SMSF choose not to apply for the actuarial certificate for the year without stopping the pension? So I guess the answer to that question there, Monica, would be if you've got pension and accumulation assets, right? So you've got the deemed segregated. If you're 100% in pension, then you've got no real choice at that point in time. But if you've got pension and accumulation, then the actuarial choice is an annual choice. So you could actually choose to use the proportioning approach in that instance. But if you're 100% in pension, then you're going to apply that segregated approach, even though the assets are not actually segregated. It's just by their very nature, they are deemed to be segregated. So again, it's one of those areas. And look, it's obviously a question without notice there, so I might go back and review that. And if there's any difference to that answer, like I've done a few times with these webinars, I'll get that put in the when the CPD goes out. But my position would be that if you've only got pension in the fund, then you're basically going to lose that loss at that point in time. But if you've got pension and accumulation, then you can make that election between the actuarial certificate or not. But I will double check that point for you. Thanks, Monica. So these are the rules with regards to full commutations. When it comes to the idea about partial commutations, then we basically need to look at effectively what our payment instructions are. So how do we wish to deal with or treat payments that come out when we're running pension and accumulation interest, or indeed even when we're just running pension interest with reference to the transfer balance cap and our transfer balance account. And so what we always have to make sure is that in every instance that we satisfy our minimum pension first. So whether we've got our periodical payment being set up, that's obviously our simplest way to ensure that we're going to meet the minimum payment. But when we've then got ad hoc additional payments beyond those minimum amounts, how are we going to take them, right? Are we going to take them as a lump sum from our accumulation interest, or are we going to undertake a partial commutation? And ultimately, there's always been these different sort of thought processes. Well, you're always going to take it out of the accumulation interest first. But there's been a bit of a sea change over the last couple of years, particularly as matters such as the transfer balance cap have really sort of taken hold within the industry. We go, okay, well, if we're still able to make contributions and we can make non-concessional contributions into to the superannuation environment, and we've got a largely taxable pension, then maybe we're going to take these amounts over and above our minimum as lump sums out of that pension interest, primarily so we can create cap space. Now, of course, we don't get any increase. If we take a partial commutation out, it doesn't give us the capacity to get a greater personal transfer balance cap, but it gives us some available cap space. So we can, in theory, pull that money out and then start an additional pension to the value of that partial commutation. So, the classic example would be if somebody's started a pension for $1.6 million back following 2017, and that pension was and they were, let's say that they were 67 years of age, and it was 100% taxable component. And now the rules have opened up and allow them to make contributions into their fund, and they're pretty much at that age now. They're pretty much at 75 years of age, so they wanted to make a non-concessional contribution to their fund. Well, they could do a partial commutation out of their pension interest for, let's say, $330,000. If they're still under 1.68, for example, they could take out the 330, and then they could put 330 in and they could then put that into a pension. They haven't altered their transfer balance cap, which is still $1.6 million. They've just created that cap space. So there's always going to be the thought process around, which way you operate, and you want to make sure that you've got the capacity within the fund's governing rules and within the pension contract to determine what the order of processing is going to be. So, you don't want to have a set and forget strategy that says, okay, all pension payments will be treated as minimum pension and anything above the minimum is going to be treated as a lump sum from accumulation, because that might not suit your circumstances. So it's really, for me, it's one of those situations where you set the pension up, you set up the periodical payment to represent the minimum amounts, and then as you need additional money, you go to make an election as to whether or not that's going to be from accumulation or to be treated as a partial commutation. So it does instill some sort of discipline into the process. But we really, from a reporting point of view, particularly if we're doing it from a partial commutation point of view, and we're now in a quarterly reporting cycle for all partial commutations and for all pension commencements inside self-managed super funds. So that's in effect from 1 July 2023 that we all do quarterly. So we need to have that discipline in place that we are reporting our partial commutations as they occur. So it's not an end of year strategy to determine how amounts are going to be treated. We need to be doing that on a payment by payment basis. So they're the key issues when contemplating pensions versus lump sums with regards to our fund. Is what are the implications of taking it from our pension interest versus the accumulation interest? And often those implications are linked not to the member, because non-assessable, non-exempt income for every member over the age 60, it often will be dictated by the estate planning elements and the estate planning issues, blended family issues, non-dependents versus dependent beneficiaries. So all of those factors will often dictate whether money is going to be drawn from the pension interest or from the accumulation interest, and as a lump sum or as a pension payment. But ultimately, the one person that impacts the least is a person whose member's interest is actually coming from. So it might have an impact on the fund's ECPI, and it might have an impact on beneficiaries' ultimate benefit, but the person impacted the least is often actually the member themselves. So that's just one of the things to obviously be mindful of. That's the positive side of the pension payments and the pension rules and paying that pension as a benefit, or paying a benefit in the form of a pension. We've then got what happens if we fail the pension standards. And as I said, I'm going to go through a number of these rules, and then I'm going to concentrate on some of the consequence issues associated with it. But we know that we've got our SIS definition of what a pension is, and primarily our number one requirement is to ensure that we pay the minimum pension amount. And what we also know is that pension will cease from the start of the income year. And this is where there's administrative anomalies, but from an ECPI point of view, if you fail to pay the minimum, then the pension ceases at the beginning of the year. Now, in a standard account-based pension, and let's talk about a standard account-based pension for somebody over the age of 60, right? The drawdown point, again, is largely irrelevant, right? So if you fail to pay the minimum, the pension ceases at the beginning of the year, and all the payments are treated as a lump sum. If you've met a condition of release, there's no issue there. But of course, if you'd set that pension up and had kept that money separate from additional accumulation money for segregating tax-free and taxable components, then that clearly is going to have a flow-on effect by failing those pension standards. But that flow-on effect is not to the individual, it's to the beneficiaries. That flow-on effect is to the ECPI on the fund. So that's where it will impact the individual, is that the fund will pay more tax, and if they've engaged in the sell down of assets during that year, then capital gains tax is going to apply. Of course, the anomaly being that from a transfer balance cap point of view, the pension ceases at the end of the year that we fail the pension standards. So we've got that ability to effectively not really necessarily impact the debit and credit requirement so much, because we would do the debiting of the full commutation on the 30th of June and the crediting of a commencement on the 1st of July. So from a valuation point of view, it's not going to create too much of an issue. right? If we go back and start it for exactly the same amount. But of course, if we're in a TRIS, we don't have to worry about either ECPI or transfer balance cap issues, but we are going to have to worry about the fact that we have access to preserved benefits. And so, as I said, I'm going to talk about the accessing of preserved benefits in a moment. Of course, if we fail the pension standards, then we might be able to apply the general powers of administration from the Commissioner to provide some discretion to say that the pension didn't cease, right? And the reality of that is that if it is less than 1/12, so if it's less than 1/12 of the minimum pension obligation that you have a shortfall for, and you pay that shortfall as soon as practical, so as soon as you recognise that shortfall, it might just be that you allocate the July payment to June to fix it up, right? Because it is under 1/12 as a minimum, then you can apply those general powers of administration, you can apply that discretion, and the pension can continue. But to apply them and to self-assess the use of those powers and the use of that discretion, you can only do that once. So that's something that you need to be mindful of. Otherwise, you have to go to the Commissioner. And if there's been an honest mistake, a genuine reason for why the pension hasn't been paid, then what I would suggest is that you seek the assistance of the Commissioner in regards to that to determine whether they will allow the pension to continue. Again, I had a conversation only at the beginning of this week with somebody who had been to a session and they were told at that session that if it was an honest mistake and you hadn't paid the pension, you'd just forgotten that you could apply these powers. Well, I would never say that to anyone. I certainly wouldn't say it in a public forum. I would always say that you've got to go to the Commissioner and seek their discretion. Now, I've seen that discretion applied where a pension hasn't been paid, and the instance that I saw it occur was someone had rolled money from an industry fund where they had a pension, and they'd paid their minimum from that industry fund, and then they started the account-based pension in the self-managed superannuation fund, and they started it in like March or April, and they thought because they'd paid the full year's minimum from the industry fund, they thought that had satisfied their requirement. I indicated to them that wasn't the case, but that they could go to the Commissioner. And interestingly, I sort of kept in contact with that client, and the Commissioner granted them that discretion to retain that pension in that instance. Now, whether that was because it was a first-year fund or a first-year pension, I'm not sure, but you don't know if you don't ask is ultimately what I would say in those circumstances. So again, if you fail the pension standards, you can lose that ECPI. It's going to have transfer balance cap issues. It could also have social security issues, as well as have an impact on your components within your benefit. So there's a number of issues that can come into place when you fail to pay the minimum. So another question here, we've got SMSF has a loan to an unrelated company and earning interest income from that loan. If interest income was paid to and cashed into the member's personal bank account, is the payment regarded as a pension payment? Well, I mean, the first thing I'd say is you've probably got a separation of assets issue there. So without wanting to go down and breach the other regulations of the SIS Act, I would be saying, well, all those interest payments should be paid to the self-managed superannuation fund, and then the pension payment made outwards. Whether you could argue in a conversation with the regulator that the pension payment has been made, I would think that there is a genuine argument there, but I would, in all honesty, I'd be trying to get that rectified to make sure that the cash flow is done through the SMSF bank account, and then the pension payments are coming out of that bank account. Because I've seen way too many circumstances in my time in administration where as administrators we didn't even know that bank accounts existed or that transactions that occurred because the trustees hadn't provided that information. So I think the bigger concern of that transaction is the separation of assets more so than the pension payment itself. So the issues associated with death benefits, because I wanted to sort of touch on this as well before finishing with the issues of illegal access and early access and other things. From a death benefit point of view, from a lump sum, one of the questions that gets asked a lot is whether or not a benefit is a death benefit or a member benefit. And the ATO, and I clicked on this link before, and the ATO is still saying this. and that is that each case is determined by its own facts. So really we're talking about the situation where a member requests a benefit to be paid and then they subsequently pass away before the benefit is paid. Is it treated as a benefit payment, member benefit payment, or a death benefit payment? And of course that can have significant tax consequences that we need to be mindful of. And the ATO highlight that the issues are going to come down to the terms of the request, the terms of the deed, and any other governing rules, the knowledge at the time the payment is made, including whether they are aware that the member has died, the entity that the payment is being paid to, the circumstances and timing of the payment, and whether the payment is made because of and in line with the request made by the member. Now, the issue here is, and they've got an example on the ATO website, and that example basically says that Jack passed away. He had requested the benefit, but by the time Jill came to pay the benefit, she obviously knew that Jack had passed away, and so it was treated as a death benefit. Now, the issue is that self-managed super fund trustees are obviously far more aware of when a member passes away than the trustees of an APRA fund. And so it's harder to argue the fact that a benefit is a member benefit versus a death benefit in an SMSF set of circumstances. However, in saying that, it may very well be that the member has initiated a benefit payment and they have started doing, say, in-specie transfers or something, or they have lodged the request to sell down an asset to pay a benefit out. And as the timing of all that occurs, they also happen to pass away. In that instance, I would be saying, well, the answer is it depends, and go to the ATO for clarification. But also the real answer is obviously going to be coming down to where has that benefit ended up being paid to? What are the tax ramifications? Because if there's no real tax ramifications to it and the money's gone to, potentially the spouse, for example, then I don't think there's necessarily anything to really be concerned with if both parties are over the age of 60. So again, probably less of a concern, but if it's going particularly to a non-dependent after death versus to the member, and there's a significant tax liability there, then it's one thing to obviously be mindful of. So okay, can you hear me now? Just want to make sure that good, excellent. I'm not actually sure what happened then. I got a little warning on the screen that said your microphone has changed, and I thought, wow, that's fantastic. I haven't actually done anything to change my microphone, so thanks for bearing with me for a moment. Okay, so from a pension issue point of view, what we need to be mindful of is when somebody dies and the minimum pension hasn't been met, then what are the consequences of that? And again, the ATO, and I'm not sure where the status of this is on the ATO website, but I know the conversation around this piece is really comes down to if you fail to pay the minimum, and largely that's going to happen with a reversionary pension. So in a reversionary pension where you have to pay the minimum amount and it maybe hasn't been paid, then you've got a situation with, have we failed the pension standards? Well, yes, you have, and so you might lose the ECPI, but then what the commissioner effectively provides for is the capacity to immediately cash those benefits. So if we immediately cash those benefits and commence a death benefit income stream, so a new pension, then that would be the way to resolve that issue. So, if you do come across the circumstances where the reversion hasn't paid the minimum pension, then clearly, and they want to keep the money in super because they can always take it out as a lump sum, then clearly what they want to make sure that they do is try and rectify that by commencing a new income stream. And if they're uncertain as to what
what the outcome is, then obviously go and speak to the commissioner. So look, what I want to finish with, and I wanted to sort of spend a few minutes talking through these issues and then touch on and finalise with that case law that I mentioned earlier. So from the ATO, we have had sort of two fairly significant documents over the last couple of years that to me impact this item on these issues the most. And the first one is that tax ruling 2013-5. I've obviously talked about it a fair bit in today's seminar, but the ATO have just released an updated draft version of that ruling, and that the comments for that ruling ceased on the 11th of November, so only in the last week. Now, the key about the update is it's really a legislative update. So the previous ruling had references to things such as the capacity to make an election to take a lump sum, say from a transition to retirement income stream, and have that treated as a lump sum versus a pension. All of those references have been cleaned up. So from a legacy point of view, this is ultimately a ruling change that doesn't really change the way that we look at things. There might be some slight adjustments or slight definitional changes, but ultimately that ruling update has been more for clarity purposes from a legislative position. The other significant one, and we're still waiting on the ATO for this, is this tax determination 2021 D6. Now that corresponded with PSLA 2021 D3. Now, PSLA is really a memo to the tax office staff for how to treat a situation. The TD 2021 D6 was really a message to the rest of us as to how the ATO are going to treat a situation. And really what these guidances were about was dealing with how or the income tax treatment of super benefits that were paid in breach of the legislative requirement, and what discretion the commissioner had in this regard. Now, as recently as May, the commissioner sort of put a hold on the final release of these documents because they had some more information that they wanted to digest. So, you know, I hope that we sort of see some answers with regards to this sort of moving forward. But I think the case that I'm going to go through will touch on things. But what I want to really highlight is a couple of the key messages that came out of these two documents, and that is that they ultimately are saying that they have the capacity to have the income. So if you illegally access superannuation, or you access it incorrectly, say from a tris or something like that, where you haven't met all the conditions appropriately, then what they would be looking at is whether or not it's reasonable or unreasonable for you to pay tax at your marginal tax rate. And so they're going to be looking at a number of matters in particular. And so what it really comes down to is that, and I've got this table here of the factors that the commissioner is going to look at with regards to the transaction occurring. And so they're going to look at the nature of the fund. Right? And so basically, if there's been an illegal access of super and it's come from an APRA fund and it's come through from an error, there's probably a greater chance that the ATO are going to be a little bit more lenient on that. But as with a lot of these issues, if they occur inside self-managed superannuation funds where the trustees have ultimate control over the payment of the benefits, then the circumstances are going to have to be pretty significant to convince the commissioner that early release wasn't involved. So, you know, tris might be one of those circumstances, and I can, you know, I have to say with all honesty, I've never actually seen the outcome of someone overpaying their tris. I haven't seen what the outcome is from a taxation point of view. I haven't seen the outcome of what the circumstances are if somebody hasn't paid the minimum. So I don't know whether or not those amounts have been taxed at marginal tax rate or not. So I can't give the answer. Maybe some of you have had those circumstances arise. But really what it's going to come down to is that if there is sort of evidence to suggest that the incorrect amount has come out, then it doesn't matter even if you do attempt to rectify it and put that money back in, they're still going to treat it as assessable income inside the super fund. So it's really critical that we understand how the process works and ensure that we understand the rules and understand the consequences, and that we're quite clear when we're talking with our clients that there are ramifications for doing things wrong. So as I said, I put a lot of information into the presentation, so you had as much of this information available to you following on from the presentation. But realistically, what it comes down to is, what led to the circumstances in the self-managed super fund, what led to the circumstance of the payment coming out, how much control did you have as trustee for those ending circumstances, and then what steps were taken to make good in the final outcome. But for most SMSF situations, again, because the trustee has control, then the ATO are going to be far less lenient than in an APRA fund. Which leads me to the case law. So I wanted to finish off with this one because it's a bit of a cracker in regards to it's the poster child for not being a trustee of a self-managed superannuation fund, but it's also the poster child for not being the tax agent or the advisor of a self-managed super fund as well. And I hope that WZWK is not on the webinar today. I'm assuming whatever those initials stand for, they're not, because they're no longer in the SMSF industry. But the fund, this WZWK fund, they basically applied for an exemption to an assessment that was issued. They applied for an assessment to be amended that the ATO had issued, because the ATO instigated an audit of the self-managed superannuation fund, and then they deemed all of the money that was released from the self-managed superannuation fund to be illegal early access money, and so they deemed it all to be assessable income, taxed at the marginal tax rate, and they imposed significant penalties. So we're talking hundreds of thousands of dollars worth of penalties on the amount that was drawn out. So there is so many things about this case that I suspect that we can use it as an example in many different elements moving forward. But what I'm going to focus on is that this advisor / accountant / tax agent / auditor was the sole director of a corporate trustee of the self-managed superannuation fund, and they determined that they were able to access their benefit under 108 of the SIS schedules for conditions of release, which is termination of gainful employment with an employer who had, or any of whose associates had at any time, contributed to the regulated super fund in relation to the member. Now, what that's basically saying is, if you've ceased work and where you cease work, if they contributed to super, then you can access your super. Now, if you've got preserved benefits, you can access it as a non-commutable life pension. If you've got restricted non-preserved benefits, then you get full access to it. So for most people, since July 1999, all benefits are going to be preserved, right? So you can then only access the money as a non-commutable life pension. Now, the circumstances around this case is that this person had a company. They set up a new company, and then they made and they had a company and they had a self-managed super fund, and then they set up a new company, set up a new self-managed super fund, and had that second company contribute into that second superannuation fund. They also did a whole lot of transfer of a whole lot of shares, unit trusts, and revaluate all sorts of valuation issues that were totally bogus as well, that created scenarios. Then what happened was the property where that second business was run burnt down. And so they made the decision that the company had to cease, because that's what happens every time there's a fire. The company has to cease. Being a little bit skeptical there in my commentary, but the company had to cease, and so his employment. So he terminated his own employment. So therefore, he was able to start a lifetime pension from his self-managed super fund based on that 108 condition. Now, the value of the fund had basically gone from like $20,000 worth of contributions to in excess of $3 million, resulting in him drawing about $800,000 over 5 years as a lifetime pension. Now, that all sounds pretty crazy. The explanation was that he was totally entitled to do it because he'd heard about it at a presentation and had done research into the legislation and said they could pay it. The tax office basically came out and said, well, firstly, that condition requires you to pay it as a lifetime annuity. Self-managed super funds are lifetime pensions. Self-managed super funds can't pay lifetime pensions since 2006. Secondly, if you do, then they are indexed amount. They don't move in accordance with account balances. So there's no way your drawdowns can go from 20,000 or whatever to over $100,000 a year. So ultimately in that situation, and then clearly the fund was wound up because he took all the money out of super, and he was 47 years of age. So the situation is that people will look at the rules and try and find ways to access their super. And we just need to ensure that we're doing things the right way. And again, as recently as the last couple of months, the ATO have given more warnings about early release of super and schemes to get access to early access to super. Over 700 trustees were disqualified in the 2023 financial year, which was 3 times the amount that had been disqualified in the previous year. And the majority of those were for early release. So penalties and early release is resulting in a huge issue for the tax office. And this case sort of highlighted that even as SMSF professionals, and particularly the penalties that were imposed because this person was an SMSF professional, and the ATO said, we have to hold you to a higher standard. So the reason I raise it as a presentation point is to say that we're all held to a higher standard because we need to understand these rules and we need to ensure that our clients are doing the right thing with regards to access to super. So look, that brings us to the end of the webinar. So the key things, the key takeaways, is obviously that we can pay our benefits as a lump sum, as an income stream, or as a combination. And then our taxation is going to be applied based on our age and the age of the recipient, particularly if it's a death benefit there. Strategic planning is going to be necessary when determining whether or not to treat money as a lump sum or a pension. As I said, it largely isn't about the pensioner themselves, but often about the estate and other beneficiaries that we need to be mindful of, and that there are different rules that apply when we come to dealing with death benefits. But ultimately, that there are serious circumstances or serious consequences when getting it wrong and accessing super early. And I would think that once we get certainty from the ATO via that determination, and I assume they will release something in the future, then the penalty regime will just ramp up, and all these people that start to call these early release amounts loans and other things will be hit with, assessable income issues and be paying marginal tax, but still having to fix the compliance issue for their self-managed superannuation fund. So thank you for attending today. Our next one, I previously indicated it would be on the 14th of December, but I've had to move it to the 13th of December. And we're doing the session on business real property, finalising at the moment dates for early 2024. So hopefully soon we can start to update you on the future dates. But thank you for attending. As I said, I will firstly I'll review that answer that I gave in relation to Monica's question during the session and put that in with the CPD certificate and with the link to both that compassionate grounds information from the ATO and a link to today's presentation. So thanks for attending, and I look forward to seeing you all at the December webinar. Thanks a lot.